Hello and welcome back to the channel. If you're joining us for the first time, don't forget to hit that like button, share this video with a friend, and subscribe to stay in the loop. Also, drop a comment below letting me know what you want to see next. In today's video, we're diving into a power-packed compilation covering for essential finance topics, tax planning, investing, financial statements, and how to fix your credit score. Let's get started. If you find this video helpful, please show your support by liking and sharing it with someone who needs to hear this. Enjoy.
Welcome to our video on the basics of tax planning. In this video, we'll be discussing the different types of taxes, tax deductions, and tax credits, and providing tips on how to reduce your tax bill. Tax planning is the process of organizing your finances to minimize the amount of taxes you owe. The most common types of taxes include income taxes, sales taxes, and property taxes. Tax deductions are expenses that you can deduct from your taxable income, reducing the amount of taxes you owe. Common deductions include charitable donations, mortgage interest, and business expenses. Tax credits are reductions in the amount of taxes you owe, dollar for dollar. Common credits include education credits, child tax credits, and renewable energy credits. It's important to consult with a tax professional to ensure you are taking advantage of all available deductions and credits. They can also help you plan for the upcoming tax year and advise on strategies to minimize your tax liability. Staying organized and filing your taxes on time can help ensure you are taking advantage of all available deductions and credits, and avoid any penalties for late filing. Remember to also be mindful of any changes in tax laws or regulations. We hope this information has been helpful in understanding the basics of tax planning, and how to minimize your tax liability. Remember, tax planning is an ongoing process, and it's important to stay informed of any changes in tax laws or regulations. Welcome to our video on managing your credit score. In this video, we'll be discussing what a credit score is, why it's important, and how you can improve and maintain a good credit score. A credit score is a numerical rating that reflects your creditworthiness, or the likelihood that you will repay a loan on time. It's based on information in your credit report, such as your payment history, the amount of debt you have, and the length of your credit history. It's important to know your credit score because it can affect your ability to get approved for loans, credit cards, and even rental applications. A good credit score can help you get approved for better terms and lower interest rates, while a bad credit score can make it more difficult and more expensive to borrow money. So, how can you improve and maintain a good credit score? One of the most important things you can do is to pay your bills on time. Late payments can have a negative impact on your credit score. Another tip is to keep your credit card balances low, and to avoid applying for too much credit at once. It's also important to check your credit report for errors, and to correct any mistakes. Managing your credit score takes some effort and attention, but it's worth it in the long run. By keeping your credit score in good shape, you can have more options and better terms when it comes to borrowing money. Another tip to improve your credit score is to keep a good credit history. The longer your credit history, the better, so it's important to keep your oldest credit accounts open even if you don't use them anymore. Another tip is to be strategic about when you apply for credit. If you're planning to make a big purchase, like buying a house or a car, it's best to wait until after you've made that purchase to apply for new credit. This will help avoid a temporary dip in your credit score. Thank you for watching this video on managing your credit score. We hope you found it informative and useful. If you have any questions or comments, please leave them below. Welcome to our video on how to read a financial statement. In this video, we'll be discussing how to read and understand financial statements, such as balance sheets, income statements, and cash flow statements, and what information they can provide about a company's financial health. A balance sheet is a snapshot of a company's financial position at a specific point in time. It shows the company's assets, liabilities, and equity. The assets are what the company owns, the liabilities are what the company owes, and the equity is the difference between the assets and liabilities. An income statement shows a company's financial performance over a specific period of time, such as a quarter or a year. It shows the company's revenue, expenses, and net income. The revenue is the money the company makes, the expenses are the money the company spends, and the net income is the profit the company makes after deducting the expenses from the revenue. By looking at the income statement, you can see how much money a company is making and how much it is spending. A cash flow statement shows how much cash a company is generating and using over a specific period of time. It helps to understand the company's liquidity, that is the company's ability to pay its bills and debts on time. By looking at the cash flow statement, you can see if the company is generating enough cash to cover its expenses, or if it's running into cash flow problems. By reading and understanding the financial statements, you can gain insight into a company's financial health and performance. You can see if a company is profitable, if it has enough cash to cover its expenses, and if it's running into any financial problems. Thank you for watching this video on how to read a financial statement. We hope you found it informative and useful. If you have any questions or comments, please leave them below. Welcome to our video on an introduction to investing. In this video, we'll be discussing the different types of investments available and the basic principles of investing. Whether you're new to investing or just looking to brush up on your knowledge, this video is for you. When it comes to investing, there are many different options available. Stocks, bonds, and mutual funds are just a few examples. Each type of investment has its own unique set of risks and potential rewards. Stocks, for example, are a type of investment that allows you to own a piece of a company. When a company performs well, the value of its stock may increase, allowing you to earn a profit. But if the company performs poorly, the value of the stock may decrease, resulting in a loss. Bonds, on the other hand, are a type of investment where you lend money to a government or corporation. In return, they agree to pay you back the principal plus interest. Bonds are generally considered to be less risky than stocks, but they also tend to have lower potential returns. Mutual funds are a type of investment that pools money from many investors to purchase a diversified portfolio of stocks, bonds, or other securities. Mutual funds are managed by professional money managers, which can help to mitigate some of the risk. No matter what type of investment you choose, it's important to understand the potential risks and rewards. It's also important to have a well-diversified portfolio, which means not putting all your eggs in one basket. Diversification can help to spread out risk and increase the chances of earning a profit. Now let's talk about the basic principles of investing. The first principle is to invest for the long term. Investing is not a get-rich-quick scheme, it takes time and patience. The second principle is to invest regularly, by putting aside a set amount of money each month or each quarter. This is known as dollar cost averaging and it can help to mitigate the effects of market fluctuations. The third principle is to minimize costs, such as investment fees and taxes. The more you pay in fees and taxes, the less you'll have to invest and the less your money will grow. And the last principle is to stay informed, by keeping up with the latest market developments and trends. Thank you for watching this video on an introduction to investing. We hope you found it informative and useful. If you have any questions or comments, please leave them below.